focus to the bond markets. The bond markets have been in the throes of some serious unpredictability of liquidity. Let's wind back to even June of 2010. Nobody expected that 1 lakh crore of bids to go out of the banking system to the spectrum the spectrum auction. Basically, it went to the government kitty. Government could not spend it. So all of last year, what we saw was the government's balance with the RBI, which is in an account called the WMA, the Ways and Means Advances. That account rising, holding a plus of 1 lakh crore or some around 70,000 crore, and the banking system in a perennial deficit of about 70,000 crore, and that deficit rose all the way by the time we came to December to 1.112 lakh crore. That was the kind of deficit the banking system had. Come back to March of 2011, ministries are in a scramble to spend money, and you see actually that the deficit with the banking system falls very sharply to about 50,000 crore, and for a few days even to a surplus, because ministries are spending money fast. And how do they spend? They just put it back in the banking system in the form of deposits for some scheme or the other, and the system runs a surplus. Remember, on certain days or for a large number of days, we saw the 10-year actually going down all the way to 7.8. There were other factors, but clearly there was a surplus liquidity in the system, and we saw CD rates, CD yields and commercial paper yields coming down. Back again in practically a month or less, from March 26th to April 15th, the government surplus of 50,000 crores suddenly becomes a deficit with the Reserve Bank of 50,000 crores, which means 1 lakh crore was spent by the government in just 1 month. It's a crazy situation for those of you who run mutual funds and for even bank treasuries, because you just don't know how much the government will spend. In 1 year, they could not spend. From June to December or February, the government couldn't spend 1 lakh crore. By the time you come to the end of the year, the government is able to spend 1 lakh crore in just 1 month. A tough situation on the hand. So how do you guess the liquidity going here on? Dhawal Dalal of DSP BlackRock Investment Managers and Nitin Jain, the co-head of fixed income at Normura, join us. Well, Dhawal, let me start with you. What have you made of the liquidity situation? Do you think the negative of about 40-50,000 crore that we have now will be stable, or are you going to see these ups and downs in the current year as well?
In fact, Lata, as you rightly mentioned, that the government had spent a lot of money in March, and part of that spending also percolated in the month of April, and as a result of which we saw abnormal level of liquidity rising and ebbing in early part of April. But as you rightly said, that I think there is going to be an uncertainty in terms of how liquidity is going to pan out in the early first quarter of 2011. We believe that notwithstanding the government spending, liquidity is likely to remain volatile in the first 2 months before becoming negative again.
All right. Nitin, similar question to you. There has been an aggressive spending by the government in end March and early April. Do you think there is a danger that, the banking system may once again turn surplus with the government running up a huge ways and means deficit with the RBI? Is there a chance of this deficit going away and the market becoming somewhat square?
I don't think so, Salata. I think the best of the liquidity driven by this March and early April spending has already reflected in the interbank liquidity, and perhaps around middle of April, by our estimates, we saw the banking system liquidity almost square. That was backed by 50,000 crore of overdraft from RBI by government, as you mentioned. Going forward, we don't see the liquidity situation improving from that point onwards. In fact, current estimate is that the interbank liquidity is now in deficit mode of about 30,000 crores. And going forward, we estimate that this liquidity situation will continue to remain perennially in deficit. 2 reasons primarily. Government drawing 50,000 crores from RBI and hence creating liquidity is almost, the ceiling for the coming 3 months. They have declared it to be 45,000 crores. So any breach of that will trigger the treasury bill auctions, and hence liquidity gets sucked out of the system. Second is the leakage through expansion in currency with the public. And between April and May, there is a large expansion in currency with the public, which is a seasonal thing, happens every year, happened last year also, and that is expected to be of the order of about 60-65,000 crores, half of which has already come, another half of it left to go. Given all that, we expect that the best of the interbank liquidity is over, and we will remain in deficit mode, and RBI will find it very easy to maintain its objective of keeping liquidity in the deficit mode.
Okay, so no uncertainties like last year, you think?
Uncertainty in the extent of deficit, yes, but whether deficit into surplus, no. I think it remains in deficit.
Okay. Well, Dhawal, then what is your advice really to a mutual fund investor? You know, we suddenly saw CP yields and CD yields going down, and once again they start shooting up. Is there any advice in terms of how mutual fund investors should play? What is an ideal fund to be in at this juncture? Any of the fixed income funds?
Well, as you rightly mentioned that when the liquidity situation became surplus in early part of April, that had a massive downward shift into short end of the money market curve, which I think now gradually heading higher. We haven't seen the kind of peak rates that we saw in month of March yet, but we expect that given the RBI's rate action due in early part of May, we could probably see money market rates picking out once again by middle of May. And the advice to the investor is to stay on the low duration funds as far as possible at the moment.
Okay. So what are you expecting, factoring in by way of RBI action, quarter, half, and what will be the impact on short-term yields, Dhawal?
We expect the RBI to increase rates by 25 basis point on 3rd of May, and they can hike further depending on what kind of fuel price revisions that we see from the government and its impact on the inflation. And we believe that the bond yields are likely to head higher from here. If you notice that the spread between 10-year Gavi and the 1-year Treasury bill is about 30-35 basis point. The long-term average about 105 basis points. So there is a lot of scope for either 10-year to go up from here or the 1 years to come down. But given the RBI's rate hiking actions, we do not anticipate 1-year T-bill to come down in the near future. So clearly there is a scope for the 10-year to head higher, but in the medium term.
Okay. Nitin, what do you think the market has already priced in by way of RBI action, and could you see some very sharp changes if it is a 50?
If it is a 50, yes, so there will be a sharp change. I don't think the market is priced in a 50 basis point. There is one more tweak possible, which is implementing the Mohanty panel report around bank rate being operationalized at 50 basis point higher than repo rate, and banks being allowed to access RBI repo window only at bank rate if they are dipping below the mandated SLR requirement. So what that would mean is there will be two operating rates to borrow from RBI, both the repo rate and a bank rate which is 50 basis point higher, and that will give a slightly upward bias in the overnight rates market. So that itself can have an impact, and I don't think market is looking at that particular scenario at this point of time. But overall, we also anticipate a 25 basis point hike only, along with the bias to dampen inflationary expectation that will continue, which will keep market on the tender hooks.
All right. Nitin, Dhawal, we'll leave it at that. Thank you very much for joining us.